Gold has fallen sharply to around $4,600. Silver is near $68. And this is happening while oil has surged to $117, though now currently $113, and the dollar index has pushed above 100, while equities are starting to come under pressure. Now that combination matters, because normally rising oil and geopolitical tension would support gold, not push it lower. So what we're seeing here is not confusion, it's a repricing. Welcome to Money and Power. If you're new here, this channel focuses on understanding what is actually driving markets, not just reacting to headlines. And if you find this useful, do consider subscribing. It genuinely helps the channel and ensures you do not miss these shifts as they developed. What's changed in the last 24 hours is more important than the headline itself. Because yesterday morning, when I sent a short note out to Inner Circle members on Substack, gold was holding above $5,000, silver was around $80, oil was closer to $100 to $101, and the dollar index was still below 100. That was a market pricing risk, but still relatively balanced. Today, at the time of producing this, which is around 1 p.m. GMT, even though the video will be published at 6:30 p.m, so please bear in mind the time discrepancy and check to see if prices have changed, that balance has shifted. Oil has moved sharply higher to $117, but as I said earlier, fallen back a little to $113. The dollar has strengthened back above 100. Equities have started and continue to fall, and gold and silver have moved down towards the lower end of their ranges. And that tells us something quite specific. Inflation pressure is rising again, but so is the expectation that policy will remain tight, and gold is being caught in between. So what you have here is a conflict. Oil rising, pushing inflation higher. Inflation rising keeps interest rates higher. Higher rates equals strengthening the dollar, and a stronger dollar puts pressure on gold and silver. That is why gold is falling and silver is falling despite geopolitical risk. Not because the risk has disappeared, but because policy and liquidity are pushing back harder. Now, just before I go further, this next part is important because most commentary stops at describing the move. But the real value is understanding what comes next and what actually changes the direction from here. Markets are not just reacting to events, they are reacting to constraints. Because normally, if oil moves to $117, central banks would respond decisively to control inflation. But today, that option is far more limited. We're already in a system with high levels of government debt, elevated borrowing costs, and economies that are far more sensitive to higher rates. So instead of resolving pressure, the system is having to absorb it. And when that happens, markets do not move in straight lines. They move in stages. What we saw first was the initial reaction. Oil rising, metals rising, markets adjusting quickly. What we're seeing now is the second stage. Dollar strengthening, metals pulling back, equities beginning to weaken. And the real question now is, what does the next stage look like? So if we take a step back and reflect, this is how I would frame the current position. Oil is the primary driver. If conditions stabilize and improve, we can see it fall back to $85 to $95. Where are we now? Between $113 and $117. If pressure builds further, however, not only is $120 realistic, in an extreme case, $150 is possible per barrel. So oil is already trading towards the upper end of the stress range. Let's look at the dollar index. Stability range 97 to 100. Now just above 100. If pressure increases, we'll see 101 to 103, possibly 105. So the dollar is moving back into the upper range. Gold. Stability range 4,700 to 5,200. Now testing the lower end, and in extreme conditions, we could potentially see it fall to $4,200. If conditions stabilize, then we get recovery within the earlier range of 4,700 to 5,200. And if pressure builds later, then we can see 5,004 to 5,006. That remains realistic, possibly even topping out at 6,000 later in the year. So this is not a collapse. It's a move to the lower boundary of the range. Now let's look at silver. The base range for silver was around $70 to $90, but we're now near $68. If calm returns, we move back into that range. But if pressure continues, then $50 to $60 is possible and cannot be ruled out, because silver is much more sensitive in this phase. Equities, stability, consolidation, pressure scenario, further downside. We have already saw a 2% decline in the last 24 hours, and it's still going down. Now there's another layer to this that's worth paying attention to, because what we've seen over the last 24 to 48 hours is not just a move in price, it's a shift in how markets are interpreting risk. Initially, the reaction was straightforward: oil rising, metals rising, simple inflation response. But what we're now seeing is more complex. Markets are beginning to recognize that higher oil doesn't just mean inflation, it also means tighter financial conditions. Because if oil remains elevated, consumers face higher costs, businesses face margin pressure, and growth expectations begin to weaken. And at the same time, central banks are less able to ease, the dollar remains supported, and liquidity becomes tighter. So what starts as an inflationary story quickly becomes a growth and liquidity story. And that's when markets tend to become more unstable. This is why you often see gold falling initially, even though the longer term backdrop may still support it. Because in the short term, liquidity dominates. And that's the phase we're now entering. So in practical terms, this is not a moment for certainty. It's a moment for awareness. Because what matters now is where we are within these ranges, what is driving the move, and what will cause that to change. If oil stabilizes, and there's no certainty about that yet, the dollar eases. Gold and silver may then already be near short-term lows. If oil continues higher and rates remain firm, pressure on precious metal prices could continue in the near term. That's the balance the market is trying to find. Now, what I've done here is outline the structure. But where I go further, particularly for inner circle members, is mapping out how I would interpret these ranges in practice, what I would be watching next, and how I would think about positioning as this develops. Because the difference is not just information, it's interpretation and timing. If you found this useful, please consider subscribing and take a look at the videos appearing on screen now, as they build on this and go deeper into how these signals tend to develop. If you wish to join us at the 2% brief, I've placed links in the description and comments section below. Because in periods like this, the risk is not just being wrong, it's reacting too late to what is already changing. Thank you for watching.